We'll move on to the first session, which is on grain markets and outlook. Our first presenter, Jeffrey McPike, took on the role of General Manager of Global Marketing for McDonald Peltz, the leading global physical commodity firm, in 2013. With offices in Australia, Argentina, Brazil, China, Turkey, India and North America, McDonald Peltz works with clients around the world, facilitating product flows within the supply chain, providing insightful information and servicing the needs of both importers and exporters. Jeff began his career in 1980 at Continental Grain, working in North Dakota, Minnesota and New York, specialising in wheat and feed grains trading. In 1988, Jeff moved to J. Urran and for 5 years was their head of wheat. He then established his own trading and consulting firm, publishing a newsletter, McWheat, On Wheat and Feed Grains, consulting for select clients and trading derivative products. That was followed by a 5-year stint in Cairo and Egypt. He's a frequent presenter at US Wheat Associates and US Grains Council conferences in the Middle East, Asia and Africa. We're very grateful for Jeff making the effort to travel here, and we look forward to his presentation on global market outlooks for grain. Jeff.
Thank you, Stephen. I appreciate the introduction. In shorthand, that means I'm an old grain trader. I've been around a long time, well before these things were in everybody's pocket. This is my first time to Australia, so I want to thank the conference organizers, Peter, Pat, Rosemary. Thank you for all your work. You've done a phenomenal job here, and I look forward to sharing with you some of my thoughts on grain, particularly wheat and feed grains. So, I'm from Colorado, and we live in a small little town called Boulder, about 100,000 people. Now, Boulder would be someplace where the shadow minister would be very happy to live. I think 2 or 3 people voted for President Trump there. That might be an overstatement. They all thought Hillary was a little bit too conservative, and they had other ideas. So we're dealing with these days of Trump in a way that many Americans are enjoying these days, and we have legalized pot, marijuana. In fact, the most popular brand out there today is something called Relax. And I can tell you everybody there is quite relaxed these days. We're trying to deal with the world, and as our previous speaker pointed out, the world is not necessarily a great place. But it's not so bad for grain. Let's begin here. How do I go forward? There. Okay. So let's start with wheat, huh? Wheat is interesting. We are involved, at least we seem to be involved, in a great drought in some areas, what I would call the Great Pasta Drought of 2017. And yet we're going to have quite a bit of wheat production in the world. We'll try to deal with these themes, though, and why cash prices aren't lower. I'm sure some of the users in the room are asking that question. Certainly a lot of the traders that I know who are short are asking that question. And we'll try to address it. We'll look at a little bit at Russian export capacity issues, not necessarily port capacity issues, but why aren't the Russians selling wheat? And we'll look at the big important issue of whether we need U.S. wheat in the world. All right. Balance sheets. That's what you do when you look at this stuff. Very comfortable. All right. 260 million tons of carryout. Okay. How can you be anything but bearish? The 4th or 5th consecutive world wheat crop that is comfortably producing more than we're consuming, or at least as much as we're consuming. So, nothing bullish here. But when you dig down, when you look beyond the gross number, you see something a little bit more interesting. You see that much of the growth in the last 4 years has been in China of stocks. I don't believe anybody in this room believes that China is going to be exporting wheat anytime soon, no matter what the price is. We have a quality issue. The Russian carry-in from last year wasn't what you would call of a quality that most people would want to buy. So we had some issues on damage. And the U.S. role, so we have the U.S. here with roughly 28 million tons of excess stocks at the end of this year. Okay? But the United States system has evolved over the last 3 or 4 years into a system that encourages storage, massive returns to storage. And that means that if the world needs our wheat, as it did last year, it has to buy it out of storage. We're not just going to sell it. In Australia, you grow wheat to export it. In the United States, we now grow a lot of our wheat to store it as an investment tool for index funds. So here's a kind of a world representation of wheat. And you see that the United States is down dramatically. Canada will be down. I'm still high, from what I can tell from everybody talking here, on my Australian numbers. Ukraine will be down. On the contrast, Russia will be higher, the EU will be higher, and Argentina will be higher. Okay? Now, it's a kind of a, it's a balanced picture, but the major exporting countries, the 5 major exporters, with Russia and Ukraine, will produce 31 million tons less of wheat this year. That could be 35. That could be 28. Still, we'll produce less. Yet, we expect that those same nations will export exactly the same amount that they did last year, when they had 31 million tons more production. Now, I'm just a humble broker, but that doesn't seem to me to paint an incredibly bearish picture from $170, $180 a ton Black Sea wheat. Okay? Assuming that people are going to want to get a return on their investment, it doesn't seem like we're going to be, and that to me is why we haven't broken early in the year. That very fact right there. Let's go next. Yeah, here we go. So, if we summarize the world wheat situation, and we're going through this quickly because, quite frankly, we have 25 minutes to discuss the entire world wheat, corn, barley, S&D, and yeah, I can do that. If we look at the summary, the world has not as much wheat production in the exporting areas, as much demand. Strong quality wheat is where we're having issues with production. And you're having a situation where the spreads are widening out. All right? The real question is demand going to stay at these kind of levels that we see? Will global food demand contract, or will it stay at high levels? And can Russia handle 20% of the world exports or more, given the challenges that we've seen with weather? We haven't had a bad winter in the Black Sea in a long time. What happens this year if we haven't? And then the point that we all talked about, one of the themes of the conference, is quality. Okay? We've seen the Australian market respond to quality. We've seen the Minneapolis market respond to quality concerns. We've seen the spreads widen dramatically as rain has come into the Baltics. Okay? This is going to be a challenging year for all of us in grains, in wheat, to deal with the qualities. The inspection services are smiling as we speak. Quality will be the #1 issue. So here's some relative prices. I just wanted to put these on here to give us an idea. Last year at this time, In August, we were trading in the 165, 170 number, FOB Black Sea, 12.5 protein wheat. We're at a much higher level today, almost $200 a ton. People were bearish 3-4 months ago until we had the production problems. And now, yeah, we have relatively low prices. We have relative abundance of lower quality wheat. And the market is dealing with that. And my colleague Sumit Gupta will talk about Indian demand, Indonesian demand, Bangladesh demand. That is one of the reasons that the low end is being supported. And the high end is continuing to get high and firm. This is good news for the Australian audience. This is good news for the Canadian audience. This is great news if you could produce any durum this year in North Dakota. Durum has already traded interior U.S. at over $400 a ton. And that's before the new crop. So here's a U.S. wheat S&D. It's not really as relevant down here, but it is if you trade Chicago futures. We see, like everybody else, lower production in this coming report in August. That'll be primarily spring wheat. But the question becomes at 25 million tons, 27 million tons, 28 million tons, does it really matter to anything but the intra-market spreads? Does it matter that wheat is $4.50 or $4 or $3.50 in Chicago? Or what really is important here is what world wheat prices are, what Russian wheat prices are, 180 for the lower proteins and 200 for the higher proteins, and what we see going on there. So in the U.S. summary, as we just talked about, we've had in the last 2 years an issue with our hard red winter wheat. Quite a bit of lower protein. We saw some of that move to Algeria last year. We're seeing some of that get ready to move to North Africa again right now, competing with Russian wheat. It's a varietal issue. It's not a weather issue. It's not it was too hot or too wet. It's simply a varietal issue, and farmers in the United States, in Kansas and Colorado and other places are responding to the price environment and the technological changes by planting a lower protein wheat. So maybe this year's spreads with higher protein will actually encourage them to go back to producing higher protein, higher quality wheats, but it should be a benefit for Australia this year. It should be bullish for your protein wheats, assuming you can produce some this year. U.S. future structure, again, if you see one thing on this slide, it's that the $3.5 to $4 a ton per month returns that warehousemen receive for storing wheat in the United States month after month after month. Okay? That effectively holds that wheat off the market. So whether the U.S. carry-out is 900 million bushels or 1.2 billion bushels or 700 million bushels, that wheat is going to be stored against the carries. And you have to buy it out of storage, and you have to remember that when you look at the wheat in the United States and say, that's bearish, or that's bullish. The monthly chart in CME. We all know what happened in 2008. We all remember the Russian drought of 2012. We've had a brief rally in the United States, a brief rally based on weather in the Dakotas, on production aspects in Canada, but that was simply noise. Russian wheat has moved $5, $10 a ton in the same period that U.S. futures markets have moved significantly higher and then significantly lower. Yesterday we were down. We were down because what? So increasingly, U.S. futures markets have become less relevant to world wheat prices. Some people are working on ways to address this. We'll talk about that, I think, a little bit later in the presentations. There. So let's switch over a little bit to world corn. Okay? You don't grow a lot of corn down here, but corn is one of the drivers of the world grains market. It is important to realize that corn has been the leader since 2005 due to ethanol in the agribusiness and the agri-grain industry. It's less so now. Soybeans have taken over that leadership due to a variety of changes, but corn is important, and then we'll talk a little bit about barley. Technology has outpaced consumption. We can grow corn like crazy in the United States. We can grow it around the world. Brazil's proving that as we speak with a huge harvest. So if you look at the corn numbers, you ask yourself, why isn't corn higher, not lower? Corn was down, what, 13 cents yesterday? Why isn't it not higher? We'll talk about export capacity issues. We'll talk a little bit about currencies, and then we'll talk about China. Okay? Because, quite frankly, there's probably people in this room who think China's got 250 million tons of corn stalks. There's probably people in this room who think they have 80 million tons of corn stalks. The real question is, does it really matter? Here's one of these little maps that I love. All right? It shows just how difficult it is to have a bad corn crop in the United States. Warm and wet weather, we have above trend yields. Cool and wet weather, we have above trend yields. Dry and cool, we have above trend yields. The technology is fantastic. Hot and dry, where we've had that kind of weather in a small portion of the United States. Hot and dry, we have had. But it's not everywhere. Here's the World Corn S&D, and if you look at the World Corn S&D, you say, yeah, it's kind of friendly. It's not so bearish. But again, if you break it down, you see that much of the decline is in China, according to the USDA. According to the USDA. Much of the decline is in China. The net carryout, yeah, for the whole world is a little bit lower ex-China and ex-United States. Again, the U.S. is a storage market. The U.S. has a marketing system designed to store and hold commodities until they improve in price. Every grain trader who's been in the States learns that as commodity trading 101. This issue, I think the most important aspect to remember about the global corn balance sheet to date is that, unlike wheat, where we have been waiting for the Russian farmer to liquidate, the market has plenty of Brazilian and Argentine supply today. Yeah, we're worried about the United States. We're worried that the United States might not have another huge crop, but today, the Brazilian farmer wants to sell corn. Today, the Argentine farmer wants to sell corn. And we really don't need that much U.S. supply. And therefore, the market prices are responding by saying, it's not a problem. Corn's not a problem. Well, we'll see if it's a problem. The next slide I have to warn you about after we get through, okay, let's get through this first. So let's look at world corn production. U.S. down at least 30 million tons. China down significantly, although that's changed a bit. Ukraine down a little bit. The Brazilian numbers are deceiving because the Brazilian harvest here for 2017 will be something that will be harvested next year. So this year's supply is actually up. China has been in the news for corn simply because they've had some very hot early weather. This slide is from one of our partners, a firm called Aware. They're one of 460 companies that are involved globally in agribusiness technology. They're a big data company. I put this slide in here in case anybody wants to look at it. These guys have developed big data numbers and can identify a virtual weather station every 9 kilometers globally. Every 9 kilometers globally. In the outline here is the Chinese corn production areas. They can show what's happened, and they can project what they think is going to happen. The industry is doing great things in predicting and using big data, just as every other industry is. This is one. In any case, the Chinese drought has broken. So over on the right-hand side, it shows a significantly increased precipitation pattern in the Chinese area. That's going to alleviate some concerns that some of us had that the Chinese were going to be very actively importing feed grains. So the world S&D, total supply is lower, but the world ex-China stocks do not go down significantly, which is one reason why it's really hard to get corn futures to rally. It's really hard. U.S. crops are still unknown. We'll talk about that a little bit more in a second. The Brazilian crop could be even sizably larger than it is already. We're not sure about the Ukraine crop. Yeah, and Chinese stocks, 350, 250, 80. I don't know. The USDA thinks they know. Other people in grain companies think they know, and that's what makes trading work, huh? Currencies are something that nobody's really going to address too much here. They should, because that's what drives premiums and flat price in Brazil and Argentina. Everybody 8 months ago, before our honorable president was elected, believed that the US dollar was going to be incredibly strong. It's been exactly the opposite. That has had impacts on premiums. It had it in 2016. It will continue to do so. The world has plenty of feed grains. Plenty of feed grains for the next 6 months. The real question is whether the U.S. will be needed as an exporter of corn in significant size in the second half of the marketing year. Not the first half of the marketing year, but the second half of the marketing year. And that's what we talk about here. So let's talk a little bit about barley. I'm not sure if that one slide that I wanted to put in here is in here. You will start seeing, before we talk about barley, you will start seeing in the next few weeks graphic pictures from the United States. Something we call cornography. Cornography is meant to excite you. It's meant to get your juices going and make you trade. Okay? It started last night, and I tried to include it in my presentation. I'm not sure if it's here. That cornography will come around and show you corn ears this long, or corn ears not even as long as your fingers. Okay? You will start hearing reports of people tromping through every U.S. field, looking at corn, giving you updates on yields. It's going to be much more intense than it has been to date, simply because this year we'll probably have a sub-trend yield. We've had such unusual weather, eastern United States wet, western United States hot and cool at different times. So start watching for the cornography. Try to keep it in perspective. Bull traders are not going to show you 9-inch ears of corn that look like they're going to yield 250 bushels an acre. They're going to show you the stuff that should be abandoned or the stuff that they grew in their backyard. Barley is a similar story as corn globally. Production will be down, yet, yet we expect world trade from those producers to be very similar to last year's level. So just as we see in wheat, as we see in barley, we're trying to basically say that we're going to have to draw down global stocks that we put in storage last year. And anytime you have to draw down stocks or bring it out of storage from last year, it means that prices have a difficult time going down. Once a farmer puts it in his bin, he has the ability to hold, whether it's in the United States or anyplace else. So when you have to buy it out of storage, it generally is a little bit friendly price, and I think that's one reason why wheat has been so strong in the Black Sea. Wheat has been so strong relatively to what the balance sheet says globally, and same with barley. So a little bit about currencies before we walk off. The dollar has been weak. I don't know what changes that. If I was a currency trader, I'd be bloody rich, and I wouldn't necessarily be here. If we look back here in 2016, when the Brazilian real went to 4.25, that's when premiums in Brazil went to unders. Corn premiums went to 5, 10 under, and then rallied as the real moved back to reality, rallied to 40, 50, 60 over before they went to 100 over. So I don't want to, when we talk about corn premiums to trading firms and others, say, what's your opinion on currency? More than what's your opinion on the balance sheet, or what's your opinion on demand? Because that's really what you're trading when you trade Brazil and Argentina. Here we have the Australian dollar, which, much to my chagrin, has firmed against the US dollar, so I can't really buy as much of your fine wine and other commodities before I go back home. Just a mention, we've gone down in the US dollar. We could easily snap back. I don't know what's controlling these currencies, if it's an aversion to our president's rhetoric, if it's just natural economics, I don't know. I'm not a currency expert. So let's look at U.S. corn. We're using a 166 yield in U.S. corn. That's 5 or 6 bushels below what the USDA is using right now. We don't think that comes in August. We don't think it comes in September. And we, quite frankly, don't think it matters a significant amount to the ending balance sheet. Whether we have a 50 million carryout, which is 2 billion bushels, or a 58, the market will handle that via intermarket spreads and via the term structure in the futures market, not necessarily by going to $3. My God, if I had $1 for every time somebody told me corn was going to go under $3 in the last 5 years, I'd be bloody rich. Everybody's been bearish corn and wrong for 5 years. It's just not going to happen. That's not how you solve the U.S. balance sheet. You solve it by a term structure. It's very simple. Again, the corn monthly chart, similar to the wheat monthly chart. Okay, everybody, let's put everything in perspective. It's been 37 years now. Everybody's complaining about how bad the market is today. There we go. How unprofitable it is. How horrible it is to be in our industry. This was pretty boring, people. $2 150 corn was not a lot of fun. Okay? Sorry. This was pretty horrible, even though prices exploded higher, because it really had no, it sent the wrong signals to the market, in our humble opinion. It's not a bad time to be in our industry. It's just not necessarily as good for producers as it has been. So do we think we're going to go back down below this trend line, which is roughly, I believe, $3? I don't think so. Not yet. Not yet. Not until we know what the U.S. crop looks like, not until we, quite frankly, know what the Ukrainian crop looks like. So, U.S. corn prospects, we had higher planted acres, and you can all read this. Always remember, 85 to 87% of U.S. corn demand is domestic. Okay? Domestic. So when the market's down 20 cents because we had a bad export number, it's not the reason. Every day we grind corn for ethanol and feed demand. That's the thing you have to monitor more than you have to monitor the export demand. And that, as we talked about, is ending stocks below 2 billion bushels. Is that 450 corn bullish? Apparently yesterday we said no, and I agree with that. If we go much lower, if we go to 45 million ton carry out, 1.8, does that mean we can rally the market? Possibly, but it depends on currencies and the other side of the equation. The grain summary, on the surface, wheat looks bearish, but it's not. And the market is acting that way because it's not as bearish as the global matrix would suggest. Price weakness, quite frankly, in wheat is possible, in my opinion, serious price weakness, only after the Northern Hemisphere plants their wheat crop and we see what it looks like in February and March. I don't think the function of the market is to break seriously over the next month or two simply to discourage the North American and Northern Hemisphere from planting more wheat. That's not the function. Corn on the surface is bullish, but we have to eat through a sizable Brazilian and Argentine new crop production that's sitting ready to move right now. The Ukrainian maize crop is what I'm focused on right now, simply because that's what China will buy if it needs corn. The Chinese stocks, somebody here, please enlighten me. Please enlighten me. What is their real stock situation? Why are they buying so much barley? Will they come back and buy US DDGs and sorghum as they seem to have? Those are the real issues for feed grains. And then, again, US ending stocks and whether it's bullish or not, we've talked about. Oh, could go back if I can. So it was interesting to hear the shadow minister before coming on here. It made me feel better about being an American, better about the fact that, yeah, we've got some real issues too. And quite frankly, it reminded me that there's a lot of negative news on our industry. There's a lot of negative news in the world. U.S. politics seem to be one of those. Refugees flowing out of the Middle East seem to be another. And as I was reminded Sunday when I was in Sydney, there are people who worship a different God than I do who want to blow me out of the sky. Okay? These are issues that we have focused on, and there's a lot of negative news out there. But quite frankly, I feel privileged to be in this industry. I'm very honored to work with many of you, and I'm very encouraged by seeing the young people that I've met over the last few days come into this industry. I love what I do. I've been doing it for 37 years, and I'm going to do it until I die. And yes, there are more people working and living in the world who are eating better than ever, who are living better lives, and as an industry, we should be proud of our contributions to that. So remember that when you go to bed tonight, that you're part of a great industry that is nurturing this planet. Yeah, there's challenges, and we're all up to it. We can do it. We can help this world become a better place. And with that, I say thank you very much, and I'll look forward to your questions.
Jeff, thanks very much. Very passionate and very informative. If we can just hold questions for the moment, because I'll invite Thomas Mielke to come up and give his presentation. As many of you know, Thomas is Executive Director of Oil World. which is frankly considered the Bible for unbiased information on global supply, demand and price analysis, statistics and forecasts for all of the major oilseeds, vegetable oils and animal fats, and oil meals, as well as biodiesel and livestock. Thomas is a frequent speaker at conferences and workshops all over the world. He joined Oil World in the mid-1970s after first studying economics. He's also a member of the Program Advisory Committee of the Malaysian Palm Oil Board, and in 2014, Thomas received a Lifetime Excellence Award of the Malaysian industry in recognition of his contribution and commitments. Thomas will speak today on global market outlooks for oilseeds, oil and meal. Thank you, Thomas.
Thank you. Thank you. It's a great pleasure for me to be here in Australia again, to share our views about the global market. What's likely to happen for canola prices, to what extent will palm oil influence the marketing of your canola in the next 12 months. Now, not easy, 25 minutes, and we are already running late, 40 minutes probably. So I have to be brief, and I have to leave out several aspects where you might be interested in, so please don't hesitate. And give me your questions where we can assist in addition to what I present today. Private company, now in the third generation. I'm proud to be the leader of a team of very dedicated analysts. We try to keep on a daily basis track to global supply, demand, and prices of all the oilseeds, vegetable and animal oils and fats, oil meals, and of course also biodiesel grains, and etc. So we also give out a Chinese report in Mandarin, and we want to be available for you. We want to be of service to you. We have no own positions in the market. Very important. So whenever we give an opinion, it's not for our pocket. We don't have a position. Yeah? Palm oil is the leader, and the outlook of palm oil prices will largely determine the canola price. Very important. And if we look at the red line here, getting nervous, to what extent will palm oil prices continue to decline? Because production is rising and is continuing to rise. Will this pull down the market even more? So this is a concern for producers all over the world. So what is a true story about palm oil? Is this really so frightening for you? And I will try to cover this. The global market, the overall target is the satisfaction of demand, and demand is very, very strong. It's really rising significantly, particularly in the food sector, and particularly for oils and fats. At the moment, not so much in meal, and this is a little bit of a concern, or even a great concern, for crushers who have soybeans, but who are not crushing the soybeans because they cannot sell the meal. Big problem. So demand and prices are the drivers for production. And prices have to be sufficiently attractive to generate further investment. And some people sometimes ask, where is the low? At current prices, which are still quite attractive, at current prices, farmers in India are not making a profit. And you have seen the news wires where farmers are in the streets protesting because they cannot survive at these prices. We may be close to the lows because we need the marginal producers medium term and longer term to satisfy demand. We need the marginal producers. And for several reasons. The necessary structural reforms are not being made in India, they are not being made in China, and these two big economies are in trouble in the agricultural sector. So prices are made, and I don't want to go into detail here, by a variety of factors, of course, supply, demand, government interference, weather, of course the weather, financial markets, currencies, emotions, very much so. Sometimes emotions are even more important than fundamentals. First subject, what is the outlook for oilseeds? Global market, 557 million tons, dominated by soybeans. And in soybeans, we have ample supplies currently, and most likely also in the next 12 months, unless the US drought aggravates, or unless we get a real weather problem in South America. But we have a big cushion of stocks. So the situation is not bullish for soybeans. Ample supplies, particularly in South America. Ample supplies. Now we see here India and China. The market share of India and China in the total oilseed production worldwide is 14%. They have come down from 20%. So significant deterioration in the market share of India and China. So India today has to import 75% of its requirements in oils and fats. India today cannot export soybean meal, and they cannot crush their soybeans they have because farmers are not competitive to sell, so they're not selling, and crushers don't have a margin. The Indian meal is too expensive, or the Indian soybeans are too expensive to grow. Big problem. Next season, the Indian crop will be down sharply because there will be a big carryover at the end of this season, at the end of August, September this year. So that's the problem. India, China falling back, but they're winners, big winners, as you know. And these big winners, like Argentina, Argentina, Brazil, the US, and Russia, Ukraine, and several others, they contribute to a significant increase in production, much steeper than the increase in area. Production is moving into the more productive areas, and yields have increased significantly. Soybeans, rapeseed, sunflower seed, yields have increased by 25–35% over the past 4 to 5 years. Very important. This is not happening in palm oil. I come to this in a minute. While the oilseed yields are increasing rapidly in the successful countries, the palm oil yields are declining. Big change. So what is the medium-term, longer-term outlook? Soybeans, the big winner, soybean production more than doubling within the past 20 years. Of course, the question is, can we continue this growth rate as area is getting tight? Also here in Australia, in Canada, US, we cannot expand much. South America, yes. Russia, yes. But worldwide, big problem. Can we really continue this trend? Or in other words, can we or can you continue to raise yield sufficiently to support a continuation of this growth with population rising and with the number of people in the middle class rising sizably? So this is the overlying question, and can we do this at these prices? Probably not. Again, soybeans, the winner, other oilseeds flat, to say the least, over the past 4 years. This is a big change. Rapeseed canola belongs to the losers over the past 5 years. But big increase in the current season, US, South America, we all know this, and there will be a decline in the next season, but does it matter? The decline is likely to be very small. unless the weather deteriorates. If it is 5 million tons or if it's 8 million tons, doesn't matter. The further increase in consumption, a further sizable increase in consumption can be satisfied without reducing stocks. Here, dependence continues to grow on South America, of course, but at the moment, particularly in Argentina, there is concentration more on wheat, on corn, on sunflower, but soybean plantings continue to decline, most likely to a 6-year low. Brazilian expansion likely to slow down, also shifting to other commodities. But it doesn't matter. Unless production decline remains moderate, we are going to have enough supplies, keeping stocks ample. US balance. In the US, at the moment, we are expecting average yields to drop by 10%. Very preliminary forecast, but even it is down 10% from last year. A crop of 113 million tons would still be sufficient, and in view of the large South American supplies for the next 6 months at least, or 8 months, the US exports are going to decline. And even with the crop being lower, we expect, as you can see, a further increase in US soybean stocks at the end of next season, on the assumption that weather conditions do not deteriorate in the next 4 weeks. Crop conditions, average crop conditions as of end July, 59% in the good or excellent category, which is down sharply from 72 last year. But yes, most likely production will be down, but it is unlikely to create a bullish scenario. Prices very volatile. I think prices have overshot the level they should. Down sharply yesterday again. $10 is probably a price which is still on the high side if we get normal weather from now on. But of course we have to look at the weather. And of course, if the weather does not recover in the next 3 to 4 weeks, the market will find reason to rally. But is it sustainable? Probably not if South America continues to expand and if South American weather conditions will be quite normal. So I don't see a big shortage in soybeans, not even a moderate shortage. And one of the reasons is China. Looking on the trade flows here, trade flows for soybeans, we have, of course, the 2 major origins, US and Brazil, and we have China taking 62% of world imports last year. China has been the big growth market, changing from a net exporter in the 90s into the world's largest importer. We expect now Chinese imports in the current season at 91 million tons, which is 63% of world exports. But for next season, we may find China to only keep imports unchanged or even reduce imports of soybeans slightly because of 2 reasons. First, stocks are very high at the moment, very high in China, stocks of imported soybeans. And second, the domestic crop is being expanded. Plantings are up, and the crop may be around 15 million tons, 3 million tons more than last year. So China could become a bearish factor on the demand side, particularly in the next 3 months, that Chinese purchases and exports out of South America to China may fall in the next 2, 3, 4 months because of these 2 factors. And this will compensate a lot of the bullishness coming from the lower prospective lower world soybean production. So at the end, we are expecting at the moment an unchanged world stock level of about 100 million tons in soybeans, which is ample by any standard at the end of next season. So I don't see a bullish scenario in soybeans unless the outlook deteriorates. And then it is probably mainly the emotions, changed emotions in the trade, which bring up the prices rather than the fundamentals. And if we get real additional damage in the US in the next 4 weeks, there is still the potential for South American farmers to react and change their planting intentions and increase more, primarily in Brazil. Oilseed crushings. The global market continues to depend on soybeans, and the dependence on soybeans will be rising again in the next 12 months. We see another big increase of 12 to 13 million tons in world soybean crushings because we need the oil, because supplies of rapeseed, canola, and sunflower seed are not sufficient, and because world stocks of vegetable oils are still very low. The problem is going to be the meal demand. And the soybean meal demand has been the laggard. If you look at Argentina, for example, Argentine soybean crushings in the past few weeks have been slowed down by the insufficient export demand for meal. Huge meal stocks of 1.4, 1.5 million tons sitting in Argentina at the moment, trying to find a home, and this brings down the pace of soybean crushings. Yeah? In summary, for all oil seeds, for all the major 7 oil seeds, we expect a slight decline in production after a boost of 50 million tons last season. So nothing really to worry about. These are our details. More or less unchanged production for rapeseed and canola. Slight decline in sunflower seed. Increases in cottonseed, palm kernels, and copra. But with the huge carry-in stocks, we have sufficient supplies to satisfy another above-average growth in consumption. Rapeseed, still a lot of question marks. We see a continuous decline in rapeseed and canola over the past 5 years. Quite alarming. Farmers are running away from rapeseed in the European Union. Rapeseed plantings in Ukraine have been way below potential. Chinese plantings have been cut tremendously. And China today is producing, according to our information, less than 6 million tons of rapeseed. The government is still estimating the crop at 12.5 million tons. It's much less. And this explains why China has purchased so much canola from Canada and Australia. Why China has imported so much soybeans. And on top of that, China has increased imports of vegetable oils. You look at the latest numbers until June. Big quantities of all oils and fats. Rapeseed oil, soybean oil, palm oil. China needs the oil. Government stocks have been reduced. Rapeseed production has dropped considerably in China. Australia, big question mark at the moment. We are still using a very, very tentative crop estimate of 3.9 million tons. We know other estimates are considerably smaller, 3.2, 3.3 million tons. We will see. Definitely less than last year. you exported 3.6 million tons of canola over the past 12 months. It's going to be down significantly. And to where? Well, mainly to Europe. We in Europe, we will be importing considerably less canola from Canada, which may fit into our balance because our crop is slightly better. We get a little bit more, or some several 100,000 tons more rapeseed from Ukraine, and probably our rapeseed crop, our rapeseed crush will be affected by the biodiesel sector. So this is something which is negative for the rapeseed side for Europe. So we may come around with importing probably 800 or 900,000 tons less canola from Canada in the next 12 months. In Canada, our tentative estimate is 18.6 million tons. Big question mark also. What is the effect of the weather in Canada on the Canadian canola? Big ranges of estimates, so we just have to wait. But in any case, the Canadian situation is tightening also because they have much less carryover. And our carryover estimate of 950,000 tons, this is of course also still an estimate. It could be 0.8, it could be slightly higher. We don't know, but it will definitely be down from a year ago. So the total export and crush availability in Canadian canola will be down significantly for the next 12 months. Now, what does it mean for prices? What does it mean for prices? And I will come to that in a second. Sunflower seed, after the tremendous increase last season, I think we have to get prepared for an, at best, stagnation, but most likely a slight decline in sunflower seed plantings. So this means that combined production of rapeseed and sun together and combined crushings of the two will be declining. Exports will be down. The world market will need more palm oil and more soybean oil to satisfy demand. So we have to keep this in mind. And let's briefly look into the oils and fats sector. Substantial growth in consumption, 6.5 million ton average growth over the past 5 years. This is a real challenge. Biofuels, food and other biofuels, of course, are important, but probably not so important in the next 12 months than before. Capita consumption, consumption per person is still low in several countries in Asia and Africa. Like look at India, 17.5 kilos, Nigeria, 15.6, Bangladesh, Vietnam. There is a lot of uncovered demand, particularly as the number of people in the middle class will be rising significantly in the next 10 years, particularly in India. So there is more demand coming. We have to keep this in mind. Biodiesel, I'm not sure whether we can continue to provide sufficient feedstocks for the global market for biodiesel and HVO. The growth for 2017 is likely to slow down. Here are the feedstocks: palm oil, the biggest feedstock, followed by soybean oil and rapeseed oil. Growth is slowing down. Biodiesel consumption is limited to the mandates because prices are too high. Prices of vegetable oils have to be at a premium to mineral oil in the red because stocks are still low. And therefore consumption of biodiesel is limited to the mandates, and there are several countries even who are not fulfilling the mandate, like Argentina, like Indonesia. Indonesia is not fulfilling the biodiesel mandate at the moment, shifting more palm oil into the export market for food. the whole oils and fats scenario. Two major contributors, palm oil. Here, palm oil is the big elephant in the room with 30% market share, followed by soybean oil, rapeseed oil, sunflower oil. These four oils are the main growth oils. And don't forget, again, over the past 20 years, we have seen production and consumption doubling, more than doubling. Tremendous growth. Can we continue this development? Now, looking at palm oil. Here, you see a very productive young tree, the fruit bunches, and loose fruit. Now, you have to collect all this. You have to collect this. You need 8 people, you need 1 person for 8 hectares on an average plantation. And this is the way the fruit bunches are collected still today in many plantations. The buffalo and the fruit bunches on the back, this is about 1 ton in the back here, 1 ton of fruit bunches. But you need the people. And over the past 10 years, wage increases have been between 100 and 130% in the plantation industry, and still the people are running away from the plantations. They don't have enough people to collect the loose fruits on the ground, to make optimal harvesting at the right time. They don't have enough people, and this labor shortage is cutting productivity. This is one of the biggest challenges in the palm industry, that it is labor intensive. Mechanization can be done, but in a limited way. And if this is not solved, and if the other big problem in the palm industry, which is replanting, is not solved, the industry will slow down. And this is what I meant at the beginning. There are challenges on the horizon, or even earlier, who are curbing the growth in palm oil production, shifting world demand to other commodities. What can this be? It can only be soybeans, rapeseed, and sunflower seed. That's it. And this is a big question mark now, and something has to happen to bring productivity back on track. Yields have declined over the past 8 years in the Malaysian and Indonesian palm oil industry. They have declined per hectare. And this is a big problem, particularly when acreage is not expanded further. Like in Malaysia, they have already announced that no further expansion in plantings. And Indonesia also said this, no additional expansion after the 2 million hectares which have already been licensed have been planted. So in 6-7 years. So there are problems at the horizon. Now, quantity-wise, and what is the outlook for the next 12 months? Let us look at this before I conclude. El Nino drought. We had this before in 1998 when yields were down 5%. World average yields were down 5% as a result of the strong El Nino. Last year, 2016, yields were down 6%. But because of the larger area, this had an impact last year of 3.9 million ton loss in palm oil production. Now, you have to take into consideration that on average, palm oil production is rising by 2.8 million tons. So in reality, production last year was down 6.7 million tons below potential. And this severely affected the industry, and it's still suffering from this. So we have to keep this in mind. Stocks are still very, very low. In 15-16, when production was down for all oils and fats because of palm oil and consumption continues to rise, stocks declined. And these stocks have not yet been replenished. We cannot despite the big increase in palm oil production in the current year, we cannot replenish oil stocks. And this, always keep in mind, what does this mean for canola prices? Low stocks, very critical. Volatility, price volatility, if something happens, if you don't have stocks to cushion supply responses. So the importance of palm oil, dominance of palm oil very clearly on the production side and on the export side. And keep in mind, it's produced only on 5% of the area, but accounts for 60% of exports and 33% of world production. Success story for palm oil over the past 10 years, doubling every 10 years, but this doubling over the past 40 years, doubling every 10 years, this is not going to continue. And it is a big question mark whether in 2025 they can really produce 85 million tons. Big question mark. And if they can't, and the extent they fall away from this target will have a direct impact on prices of soybeans, of sunflower seed, of canola. So I cut this short here, the trade in oils and fats. I want to look more closely in the quarterly situation. What does this mean for prices? What does this mean for prices? Now, we start again in the deficit area here. The quarterly world production in red is the production, in blue is the consumption. Big, very big reduction of stocks, and then production recovered. But the recovery is going to stop in October, December. So there is a limit. Now we can look at it more closely for Indonesia. In Indonesia, most of the year-on-year growth in production is already behind us. And worldwide, 70% of the growth in world palm oil production occurring in 2000 or likely to occur. It's still an estimate, and we have to be careful. Yeah, it may be wrong, but this is how we see the market, and what our models and what our interpretation shows us. After the big jump of 3.2 million tons in January-June, there will be only a very moderate increase of 0.3, probably 0.5 million tons from a year ago in July-December. If this is correct, then the supply pressure will become more moderate for the next 6 months, if this is correct. We started the beginning of July with very low stocks in Indonesia and Malaysia. All or most of the growth in production has been consumed in the world market, has been exported to the world market, and Indonesia and Malaysia stand there with relatively low stocks. Now, production is going to increase seasonally, this in July, September, which can bring down some pressure. But October, December is very likely to be unchanged from a year ago. No increase, no further increase. And this is changing the fundamentals. And probably you should not become too bearish on this outlook. In summary, world production rising tremendously by 7.1 million tons in the current year, but most of that has already happened. Yields are still down from 2 or 3 years ago, so question mark. Profitability, question mark. Labor shortage means losses in the field. Outlook for next year, another increase, but less of an increase, probably 4 million tons. Production will continue to grow, yes, for 2018, not so much for 2019-20, for different reasons, but I'm not bullish for palm oil for the next 12 months, but I am warning that most of the price adjustment is already done, already discounted in the price. In conclusion, the world needs to rebuild stocks. In red, stocks also at the end of the 17-18 season will still be relatively tight. Oilseeds probably sideways or bearish unless weather problems occur. Stocks usage ratio in green still comfortable at the end of next season. We need a additional real weather problem to make this oilseed market, to turn this oilseed market bullish. Replenishment of stocks will take time and may not be completed in 2018. And finally, have we already reached the lows? Look, the situation at the beginning of June. The situation at the beginning of June. The nearby was 710, and the October-December $595 for RBD palm oil in FOB Malaysia. An inverse of $108. This was at the beginning of June. On July 24, October-December was up 625. And the inverse, very, very small. Now, some consumers already covered their requirements for October-December when prices dropped below 600, and also for January-March. And this was the right thing to do. Well, you're always very, very intelligent, backward-looking. I know this. And it is never possible to reach the highs or the lows. It's never possible. But I think this is an interesting change we have seen over the past 2 months. The deferred positions have come up, and the inverse has slowed down. This is probably already a reflection of an easing or a reflection of the market expectation of an easing supply pressure. We don't know the we don't know the July numbers yet, but there are reports that in July production in Sabah and some other places was below expectations. So it is probably an indication. I'm not saying that we have reached the lows. I don't think we have reached the lows. Prices can go lower temporarily, but not very much. For FOB Malaysia, we can see palm oil prices to fall below $600. It could be temporarily 590, 580, we don't know. But it was in the next 3 to 5 months, but only for a short period of time. And then consumption should kick in. Consumers are not well covered. Consumption should kick in and bring prices higher. I would say the palm oil market is in the process of bottoming, and we just don't know how long it takes. And for the futures prices, Malaysian futures, I don't expect that we will fall below 2,300 ringgit during October-December this year, or for the October-December position. This also means for canola, I think canola prices should be supported by the tightness in the world market. At the moment, prices are quite attractive, I would say. I see little risk of canola prices falling below current levels, being supported by the prospective development in oils and fats, particularly palm oil. With this, thank you for listening. Thank you very much.
Thomas, brilliant. Thank you very much. obviously we are running a little bit behind. Are there any questions that we have from the floor? Please take advantage of two, fantastic experts. Made a huge effort to join us today, so please, are there any questions? Okay, well, look, I've got a couple just to get things moving. Pat, if you can please just introduce yourself.
Morning, it's John Slee, President of Australian Oilseed Federation. I'll probably try and get a two-answer with one question. That it didn't really cover the other fats or the tallow side of things at a grains conference, but it does have an impact back on the vegetable oil side. And one of the big question marks have been around biofuel sort of policy, especially the US one. So I'll probably get Jeff to make a comment on where he sees the US biofuel policy going under the new sort of government. And here in Australia, we've seen a big decline in tallow prices over the last 3 months. So I'll get Thomas's sort of view on the tallow price outlook. And it's probably has been linked a bit to palm, but it's been more to that US biofuel side of things. So get a comment from both.
Is this on or no?
Just.
So you're trying to ask a very logical question to a gentleman who lives in a surreal world of Trump mania, whatever you want to call it. Logically, should we continue our biofuels policy? More than likely we will. The infrastructure is there, the jobs are there, the corn is there. It has helped, quite frankly, to free us from the, if you will, the tyranny of the Middle Eastern oil situation. We are oil independent now, and we produce in excess of what we need in gasoline and fuels. So should we continue it? In my opinion, yes. Does it cost a little bit of money? Sure, but it guarantees jobs. I don't know if we'll do that. We can't even keep a press secretary for more than 2 weeks. So deciding whether we should have a long-term ethanol or biofuel policy, my goodness, that's advanced calculus. It's beyond the norm right now.
I would be a bit more optimistic. There are so many corn farmers out there. I don't think that the government will touch this issue and reduce it. I would rather see a very high likelihood that the credit is being shifted to the producer's credit as compared to blender's credit, that Argentina will be shut out of the US market, and that Argentina will find a new open door in Europe exporting biodiesel to Europe, which would be mainly Spain and Italy. So this would not affect very much the rapeseed. It would affect imports of palm oil and probably consumption of soybean oil. Tallow prices, you want my opinion on tallow prices? I think the US tallow price is highly overvalued. With these price premiums we have at the moment, consumption should decline for US tallow. Australian tallow, a discount of more than $200 below RBD palm olein or palm stearine or PFID, whatever, palm fractions. Tallow, Australian tallow, I really don't know what's happening. Probably somebody is telling a lesson to the Australian producers. But even if that is the case, of the one big consumer or importer of Australian tallow, you should find a lot of buyers at these very attractive prices in China, in Nigeria. I understand one ship is already on its way to Nigeria with Australian tallow. These tallow prices are much too low for Australia. I think it's a very good buying opportunity, but you have to bring, and I mean, if you invite me, I say what I think, so I apologize, You have to bring your things together. And if you cannot guarantee quality, and if you don't find the boys or girls doing a bad job, and really monitor before you blend, I think you can do your part to have an improved tallow which you offer for export, and then you will see tallow prices at least at the price of palm oil, but I think most likely at a premium to palm fractions. So much undervalued, very temporary, but you play your part in it, and you can, again, you can do better than you do at the moment. Thank you.
Thank